Good evening and welcome to ET Now's special one-hour coverage of a trouble that really looms over European Union, and it could have a domino effect on financial markets. Thanks for tuning in. I'm Nikunj, Dalmia.
And I'm Tanvir, Gill. Over the next 1 hour, we'll be tracking the complete story on Greece and its impact really on world markets. The Greece debt crisis continues to loom on market sentiment, and it's going to be one of the key aspects that will dominate trade all of this coming week. So we thought best to summarize the story as it stands, given all the latest updates that are coming in from the European Union as well as the Greek government officials. In fact, it has been an eventful weekend. If market watchers were looking at answers to the Greece's debt situation right now, the crisis that is currently ensuing in the region, and its position also as a member nation of the Eurozone, those answers have been delayed as the Greek government has called for a bailout referendum on 5th July. And this has been a surprise for everybody, especially the European Union, that wasn't prepared for the referendum to be announced so suddenly and so soon. That leaves us with the big question: what happens to the 30th June deadline for the impending payment of Greece's interest to the IMF on the loan that extends out to the organization? And will the inability to pay qualify Greece as a defaulter? And if so, how would the referendum outcome help in any way, as the default will pave the way for a Greece exit? If not now, then eventually over the course of the next 6 months. So it just seems like a matter of time, and hence the clock is ticking.
The clock is ticking. 1 minute it appears that there is a deal in place. The very next minute it appears that there is no deal in place. And honestly, this is a live story, and this will keep financial market watchers glued to the screen. As of now, it appears that a deal could be in place, but the verdict could change in the next 60 seconds because this story is evolving. And the future of EU, the union which was made about 15 years ago between with over 1 dozen nations, that really stands. So it is the common currency regime, Tanvir, which really would be tested going forward.
Let's just throw the house open with key questions that our guests will answer over the next 1 hour on how this impacts what happens over the next 2 days. How does the imbroglio currently ensuing in Greece impact world markets, and more specifically India? So we have Ajay Bagga talking about the India impact, and we also have Dr. Rebecca Harding, CEO Delta Economics, putting things in perspective from London. Good evening to both of you, and I'll start off with you, Dr. Harding. What's your own assessment? Join the dots for us. How critical does the situation look now? And, if they do not make the payment on June 30th, the IMF has said that there's no more time that they will be given. It's pretty much a deadline that they have to honor. Does that mean that they would be qualified as a defaulter?
I think if you look at the situation right now, you're looking into the barrel of a gun. I think it's very dangerous, and I think the politics that are being played at the moment are very risky for European markets, for European people, for the Greek people in particular, but also for global markets as well. So I think what we're looking at the moment is a situation which is very volatile and very uncertain. There's a lot of counter briefing going on about what the ECB has suggested. They've just come out with a statement that was releasing information that was there on Friday rather than Thursday, which is what the Greek people are being asked to vote on. And I think the problem that we're seeing at the moment is that there's a lot of confusion. Will the Greeks default? At the moment, it looks very likely. Whether that default will be on Tuesday or not, or whether there'll be capital controls and they'll be able to make some kind of a payment, is still open in my view. There is no mechanism for an exit at the moment. This hasn't been documented. It's kind of the unthinkable. So I think we're in a situation where nobody really knows, but default is looking increasingly likely.
Ajay, frankly, I'm surprised and impressed with the way how financial markets have really handled the Greece problem. As of now, no major markets are panicking. Everyone is talking about Greece, but no one is reacting.
No, Nikunj, that's for me?
That's right,
yeah.
Ajay, that's for you.
Yeah, sorry. I think the surprise element took the markets, unawares. Friday midnight, the Greek negotiators learnt on Twitter that their prime minister had announced a referendum. They were actually talking together the ECB, IMF guys and the Greek negotiators all came to know on Twitter. And the finance minister of Greece, about a couple of hours earlier, had sounded positive. So I think everybody got taken by surprise. Just to put it in perspective, it's an 11 million population country, 240 billion of GDP, so not very big. Market cap, last I checked, was some 22 billion dollars. So not a very big country to engender that 19 European finance ministers have virtually been camping in Brussels for God knows how many days now. And the way things are moving, the biggest issue is, does it become a domino or does it become a ballast? So if it's a domino, then the next one is Portugal, where the elections come in another couple of months. Will a similar government come in? Or is it becoming a ballast where you jettison something which is not working and the rest of the union becomes stronger? I think that will take a lot of years for it to come out. As Dr. Harding also mentioned, I've been saying that earlier on your channel, when the treaty was signed, there was no exit clause put in. Today, 2 times the Greek finance minister has said that legally there is no way to exit the euro. And that is the truth. There is unwritten traditions which you can follow, very broad interpretations, but there is no way that you can go to a national currency from a unified currency now. So I remember in 2012, there was an award-winning essay by some capital market economists, and I had read that in great detail on how Greece would need to go about it. And that really talked about shutting down the banking system for more than a month. And then when you reopen, you are going to reopen with drachmas, right. And you have to reword all the contracts. It's not easy. We saw in Cyprus, luckily in known history in the last 2 years, we have the Cyprus example, Nikunj, where for 12 days the banks got shut.
Right, fair point. And I want to take that point forward, Dr. Harding, with you. And what I really worry about, that this Greece problem could have a huge implications on the way politicians will approach austerity. Now, the world does not need austerity, they need productivity. But if the current political setup survives, that will be a victory for really austerity.
I think you've raised 2 really important points there. The first is the political aspects of all of this, and the second is the issue around austerity. To address the political point first, I mean, I think what we're seeing is actually a few political chickens coming home to roost. We're seeing a situation where Greece is actually being held hostage to the fact that a lot of the agreements and counter agreements and negotiations actually haven't been documented before, but there is actually a very strong will and a very strong reason for keeping Greece in the European Union, and particularly in the Eurozone, because of the contagion effects and because of what might happen. Now, I think the second point is actually an economic point on austerity itself. And the problem that Greece has is that it's never really had the capacity to build long-term growth and therefore start talking about debt repayment rather than debt rescheduling. And I think you're absolutely right, thinking through the infrastructure spending that's necessary by the ECB in order to be able to put Greece on a growth path is actually really important at this point. Now, the documentation, and I have literally only just read this because it's off the press in the last 3/4 of an hour, but the European Union, the ECB in particular, is saying that they are actually addressing some of those growth issues and some of those infrastructure spend issues, but that Greece had walked away from the table beforehand, so before they could make this explicit. So there is a little bit of vagueness around what the ECB was offering.
And I think that vagueness is weighing on market sentiment. Manish Singh, strategist and head of investments at Crossbridge Capital, also joins into the discussion. And Manish, maybe you could throw more perspective on that point. How do you think the markets would take to this? Because, it's been a yo-yo really for the markets this week, with every statement, drawing some sort of analysis on how it would impact overall sentiment in world markets, over the course of the next 5 days, because we have one deadline on June 30th, which the markets would react to. Of course, July 5th is a weekend deadline, but it would be an important one if Greece misses the payment How do you think the markets would take to that?
I think that it's fair to say that you will have volatility in the market, especially in the peripheral equities and especially in peripheral bank equities in Europe. Now, the only deadline that really matters is when ECB cuts the ELA funding, and they haven't, because just today they made a decision that they are going to stick with the same limit as they had on Friday, which is a positive sign. In last few minutes, there have been many tweets and details about that. Back channel negotiation is still going on, even though it has stopped on the face of it. So my view is that you're going to have some volatility in the market, but as I have mentioned before as well, the risk of contagion is low, just because we have ECB printing money. And not just that, even the European Court of Justice has came out very strongly in favor of ECB's OMT program. So I think the risk of contagion is very small. That doesn't mean that you will not have volatility, because people are going to sell a few things, and especially peripheral equities. But I do not see this as a big problem, because I still think that there is going to be a deal, but maybe it'll go through a capital control and then you can come to a deal. But maybe that's how it's going to happen, but I'm still hopeful we'll have a deal.
Right. Arnab Das, this question is coming your way. Greece is keeping us busy on a Sunday evening. Okay, Arnab's not there. Ajay, so let's really talk about...
You're all working on a Sunday
you're
evening,
working on a Sunday and discussing Greece. Tomorrow morning, when markets will open, do you think we should focus on China and not Greece?
Yeah, China did a fourth rate cut. I think Chinese have been ahead of the curve, and now how does this impact? I think there will be some exit of foreign investors from emerging markets. That's a given. In India, we have seen 2 months in a row of FPIs, net exiting the equity markets as well as the bond market. So China is delicately poised with a 20% cut, both on the Shanghai and the Shenzhen indices. So this rate cut and the reduction in reserve requirements will lead to some amount of support, hopefully. Let's see how that pans out. Overall, Nikunj, the situation is much better than 2010 and 2012. So the fear of contagion is much lesser. But emerging markets, unfortunately, it gets accentuated. So, and bigger markets like India, we have seen if people are not able to exit positions in Thailand and smaller markets, we see that our large caps get a brunt of that sell-off. So I am a little worried about the Indian markets in the short term. You could see some bout of FPI selling tomorrow.
Dr. Harding, comment on that point that Ajay made in his previous answer about, this is not just a situation about Greece and its position in the EU, it's also about the domino effect. So if Greece was to step out, how would events play out then? Would it then bring Portugal, Spain, Italy, some of the other peripheral European countries which are also weak at this point, have high debt levels, high unemployment levels, they're trying to step up on austerity. Does the focus then shift to them, and does it become the larger issue of whether the euro will survive?
I think that's incredibly important, and I think whatever happens with Greece, there's going to be some kind of a knock-on effect on other countries as well. And the reason for that is simply this. If Greece defaults and leaves, then, in the short term, that actually will be something that maybe markets will welcome. Everybody will say, oh, well, that means that it's actually now just Germany, and the German market is very strong. Europe's growing. It's actually looking quite healthy at the moment. But I think 15, 18 months down the line, and then you might see Spain and Portugal begin to say, well, hang on a minute, this actually isn't a good deal for us, and start to want to renegotiate because there are deadlines coming up with those as well. But I think the other thing is, if Greece stays in, actually for Europe, there's also a very big political risk as well, which is that there has to be some kind of massive debt forgiveness or debt renegotiation, because Spain and Portugal and Ireland and Italy will all want to renegotiate the terms of their deals and the terms of their debt with the European Central Bank, and that's very likely. So it's a kind of a damned if you do and damned if you don't at the moment, and there is going to be a long-lasting consequence of all of this Greek process. And I think that, in a way, is why we're all being kept working on a Sunday, because everybody knows that even though Greece is small, and even though at the moment things can be limited, over a longer period of time, actually this is something politically or geopolitically that's very important. The collapse of a whole trading bloc, arguably, and a currency is a very big deal. And that's why people are worrying about it, even if this particular incident might be quite small.
Manish, frankly, I don't worry about the economic consequences, but I do worry about the geopolitical consequences, Manish, because of late there is enough and more evidence that Russia and Greece are talking. Russia needs a footprint in Europe. Greece is desperate for financial aid. So if Greece exits, it could change the political map and the geopolitical map of Europe.
I agree. I think, Nikunj, your point is very valid. And therefore, I'm saying it's so important for EU and Germany to keep Greece within. And that's one of my main bases. Another basis that if any country leaves EMU, then EMU changes forever. It becomes like a fixed rate system, which is what Bretton Woods was. So my view is that the leadership in Eurozone and EU clearly understand that. The bigger question also is that you could have a really big problem in Greece alone, because typically you have seen protests in Greece, but whenever they have seen protests in Greece, people have united together to protest against the government. Now this time the government has left the obligation and given it back to the people. You will have two opposing camps, one that wants to stay in EU and one that doesn't want to stay in the Eurozone, clashing with each other. You could have major problem. So you're absolutely right about the social unrest and things that are going to follow. And this is one of my main views, that Greece has always been about debt sustainability. So they had a budget surplus. Now it has been eroded because of various other measures. So creditors really have to rethink, and I believe they are, which is why you will see that French President François Hollande has mentioned about debt relief. The other members have not mentioned about debt relief. But I have a feeling that they have lost faith in this government, in the current government. So it could be that we go through an iteration where it leads to an election, or this government goes away. There is a new leadership that comes on. You have a negotiation, and debt relief has to be part of that. So I believe that that's my scenario that I have in my mind. But to your point, I do agree that if Greece leaves Euro, and then if it becomes one of the states of Russia, or Russia has an involvement, then that is a much bigger problem. So if the current situation is bad, that situation is going to be terrible.
Which is why perhaps you're seeing a lot of the EU officials make very pro-union remarks, saying that they definitely want Greece to be part of the Eurozone, and that they would do their best to work out a deal if Greece has its will. We'll continue with our coverage of Greece's debt wish, analyzing the debt crisis currently underway in Greece and what it does for world markets in the coming week. After this very short break, stay tuned to ET9. Hi there, welcome back to Greece's Debt Wish. Right here on ET Now, we are bringing you the complete story on Greece's position in the Eurozone and whether it will stay for the coming week.
And I guess the reason we are calling it the Greek drama, Tanvir, is that with each passing minute, the entire scope of the negotiation it is actually like a Greek drama. Yeah, no wonder the original dramas originated from Greece.
Of course. In fact, keeping it with getting more opinion and getting as much perspective as possible on this issue. Arnab Das, Managing Director Macro Strategy at Trusted Sources, also joins in from London. Arnab, we've been dialing you each day for the last 4 sessions talking about this issue. What is the perspective that you have gathered from amongst your sources about how one should be approaching the coming week?
Well, I think very cautiously is the bottom line here. As I suppose everyone will be aware, it appears that the negotiations were broken off, and a referendum has been called and approved by the Greek Parliament for whether the people of Greece want to go ahead with the proposal from the Eurozone or not. The language around this process and the mechanics of it, I guess you would say, have been perceived among Greece's creditors and the IMF as confrontational. I guess you'll be aware that The ECB has left the emergency liquidity arrangement by which it helps Greek banks to finance the run on deposits that has been taking place and has accelerated even further. It has kept it unchanged, so that will tighten the noose around the Greek banking system. Many ATMs and so on are already running out of money. So I think the tension between Greece and her creditors is rising, and the tension between the Greek population and the uncertainty around this whole thing is also becoming more serious and maybe even coming to a head. You were just saying how Greece is where drama is originated. Greece is also where representative democracy originated. It also happens to be the place where we have the first recorded sovereign default. So there's a lot of things that are in play here. And of course, the idea that the Greek people have elected a government to represent them that presented them the hope that they could remain in the euro and not have as much austerity and adjustment and reform as previous governments had agreed to. That's obviously the crunch point here. And the other states in the Eurozone, both creditors and other debtors that feel they have adjusted more than Greece are saying, no way. We can't be expected to tighten our belts as much as we have, so that you don't have to tighten your belts as much as, we think you need to. So I'm not sure that there's any good resolution here anymore. I still think that there's a scenario in which Greece, has no accommodation with its creditors, but at least for a while remains within the Eurozone. Of course, as everybody knows, the first crunch point on Tuesday is going to be with the IMF, and if they don't pay there, then that's going to be a serious problem to contend with, both for Greece and for Europe itself, and even for the markets, because Greece is obviously the IMF's largest borrower now by a long shot.
Since there is no exit clause in place for Greek, because when the original treaty was signed, there was no exit clause which was put in place. What will force Greece to exit? What will it take for the union to break? Who will decide that?
Well, so first of all, I think, it's conceivable that Greece could exit by, responding to this. Let's say that the referendum goes ahead and the Greek people vote effectively no. They won't have all this adjustment and reform. Then it may well be the case that the ECB further tightens the screws and doesn't want to give Greece more leeway to issue more euros in order to finance its banks. In that scenario, and possibly even before then, right, because the referendum is on July 5th, because the Greek banks are running out of funds, the Greek government may have to impose a deposit freeze and impose capital controls. At some point, that will become untenable, and it may feel that it has to issue some kind of parallel currency or some kind of money, and at that point, for all intents and purposes, people will conclude that Greece is either out of the Eurozone or on its way out of the Eurozone. Now, of course, as you say, there's no legal mechanism. There's nothing in the treaty that provides for this, and it is legal opinion that a country cannot exit the Eurozone without exiting the European Union, which, of course, then adds a further layer of complexity and difficulty, because that would end, or at least threaten to end, Greece's numerous free trading arrangements within the customs union that the European Union represents. So it's a very complicated situation. It's obviously clearly without precedent in all of those respects. There's also danger here, although I continue to believe it's not a systemic threat. There's also danger here for the Eurozone that the first exit of what is supposed to be an irrevocable monetary union, people will look at that and they'll say, okay, well, this means that for some countries under certain circumstances, it is not a monetary union, but is just another fixed exchange rate regime. And those kinds of things break all the time. And if that's a risk, then that risk needs to carry a premium for which an investor or a creditor in a country that might leave the Eurozone should get paid a premium. And of course, that premium had become practically zero during the heyday of the euro, and even negative in some cases, with countries, including Greece herself, trading more expensive than Germany for periods of time. So those risk premia would come back in, and that would be a form of contagion. Like I said, I continue to think that the fire breaks that the Eurozone has implemented already, has in place QE, quantitative easing, has in place an idea of outright monetary transactions to quote-unquote restore the singleness of monetary policy. These actions would help mitigate the damage, but of course, at least initially, there would be some damage. The damage would be of a different character, I think, than in 2010, 2012, when everybody feared the banking system in the Eurozone would collapse. Now the banks are much more domestically funded and have much more domestic assets than cross-border assets, even within the Eurozone. So the chances are much better that the banking systems could be supported by the ECB and also supported nationally without collapsing. But of course, people would worry much more than they have in the recent past. And so I think, tomorrow and the coming days will be quite tough in the markets generally, and particularly in Europe, and of course, especially in Greece.
What would it, Arnab, before we kind of take on questions with the other panelists, what would this mean for the euro? I mean, we've seen the currency hold out about 1.10. Where does the euro go from here?
Well, I think it's a bit ambiguous. There probably will be some weakness in the euro, but there will also be a kind of cash is king, at least in the short term, a kind of cash is king view around the world. And so there'll be some amount of repatriation, I should think, into the Eurozone because many people will have put on euro-funded carry trades, both foreigners borrowing euros and residents either borrowing euros or doing outright carry trades on purchases abroad funded with euros. And they may fear that they need to cover those euro positions. Right. And so some money, I think this is already going on, is already coming back. So I don't think we're going to see an immediate collapse or anything like that in the euro exchange rate. And there'll also be the intellectual argument that a eurozone that does not have Greece is going to be somewhat stronger.
Fair point. So, Manish, let's talk about the euro. Do you think it's a matter of not months now, it's a matter of weeks? Euro will go to parity against the dollar because that big reset has happened. And if that has to happen, that surely will change the dynamics of world trade.
Well, I mean, I am not of the opinion that, euro dollar is going to parity. And my view is very simple, is that the Eurozone data, if you leave aside what is happening in Greece, is getting much better. If you look at the bank lending survey data, which gets published by ECB every quarter, those numbers are looking much better. Real economy is getting the money. The GDP growth rate is ticking up. PMI numbers are ticking up. Spain is showing growth. So I think that a lot of story is very positive for Eurozone if you just set aside the Greece news at the moment. So I am in the camp that euro dollar going to parity is not my view. In fact, I see that you could have a euro dollar rally in the short term, which I mean over a quarter, until such time as US starts raising rates. When US starts raising rates, then you will have some fall in euro dollar. But my view is still that euro dollar could go down to 1.05 by the end of the year. Because again, in US, I expect only one rate hike this year and maybe a 2 or 3 rate hike next year. But that's my base case. In fact, I see euro hitting 1.15 at some point this year before it goes down to 1.05. So for me, the path to lower euro goes through a higher euro, and my year-end target is around 1.05.
Right, Dr. Harding, you want to comment on that? The market impact as you see it for now, or in the near term at least, do you think the markets would take every development that comes out of Greece with a bit of nervousness, or there would be perhaps a silver lining to the fall?
I think at the moment, for the next couple of days, you're going to see a vast amount of uncertainty. I think you might see, I think at the moment, all bets are off on whether the market opens higher or lower tomorrow. I suspect it'll open lower simply because people are uncertain about what the outcome of the next week is going to be. In terms of euro US dollar, I think you're likely to see a risk off trade at the moment. I think you're likely to see money come out of Europe and more likely to go into the US dollar, and therefore I am of the view that a closer move towards parity over the next month is likely. And if there are subsequently hikes in US interest rates, I think we may very well likely see US dollar euro parity by the end of the year. I think the other contributory factor here is that what's likely to happen, rather than a full Brexit, even at this 11th hour, is some kind of compromise and some kind of a deal that actually allows Greece to stay in, debts to be renegotiated, and in some sense the can to be kicked a little bit further along the road. Now, one of the things that was being discussed last week was actually renegotiating and coming back to the table in November. I think markets are very likely to lose patience with all of this constant can kicking. To some extent, it's boring. I know a lot of traders who are saying, well, actually, at the moment, this is just boring. I mean, why are we even bothering? Let's just price it in. But on the other hand, there are these big geopolitical consequences of it. And I think at some point, markets will lose patience with the capacity of European policymakers actually to be able to come up with a long-term solution. And at that point, you could very easily see a run on the euro.
I think that's a great point. As of now, financial markets have been mature. They've not really panicked, but will this can kicking force financial markets to lose their patience? And Ajay, I'm going to talk about India and implications of a weak year on India. Now, IT companies came out with horrible set of Q4 numbers and they blamed it on cross-currency headwinds, which is largely euro. Given that euro is likely to weaken more, can I smell more bad news? Can I sniff more poor commentary from IT companies?
Yeah, good news is that this quarter is done, Nikunj, so it will be in the forward guidance that they will probably bake it in. But my very simple advice is this is not the time to invest. So lighten positions. I think we're going to see an Indian market opening with a gap down tomorrow. The EM contagion comes in. We have seen that with Turkey, with Argentina, whenever even uncorrelated countries are seeing an issue, we see the Indian market in a sell-off zone. So it looks pretty much a certainty that you would have a gap down on the Indian markets. Sector-wise impact on us, very little correlation to Greece per se. But as you said, cross-currency haircuts, both in IT and a little bit in pharma could come in. Probably next quarter. This quarter is over, more or less. The third point is that it has been a game of pretend and extend by all the parties in this game. Greece has been in default. When you did the 240 billion euro repackaging 3 years back, it had gone into default. GDP is down 25% over the last 5 years. There's no way they can really proceed without taking serious haircuts. Now, what will happen there? Is the market rightly pricing it? Nobody knows. Look at even the referendums there. 80% are supporting the Prime Minister, but 70% are saying we want to stay in the euro. When the Prime Minister has said, say no to the referendum, his Finance Minister tells BBC that we hope the populace says yes. And then he tweets an hour later that we are against the referendum going through. So it's a lot of confusion for markets to digest. Best would be to stay light. I think you will get money going into German bonds tomorrow. You will see the peripheral bonds losing. You would see some European sell-off. And again, safe haven, probably gold going up tomorrow. Those are a few bets that look pretty good. You can buy Swiss francs, for example. I think more headache for the SNB, which has been battling with a continuously strengthening Swiss franc. I think you will see money going from euro into Swiss francs tomorrow. Those are trades which look very apparent, but very confusing picture. the France and the German governments are keen secretly. They would want to pretend and extend, because you can't crystallize. Between the two of them, they have 160 billion euros of exposure. These two, the Chancellor and the President don't want to go down in history as the people who took the highest write-offs for France and Germany. So I think it's been overreaching by the Greeks. They thought this would really push a deal. It has led to a bad reaction.
Right.
Unfortunate for the markets, Nikunj.
Sure. In fact, as all our panelists have been saying, the reason why this becomes even more critical, this whole Greece crisis, is the fact that it's become a larger geopolitical issue now, more than just an economic issue, which maybe the impact of which is a bit limited. But Manish, come to you. And in one of my conversations off the record with some of the fund managers based out of the US, they were of the opinion that if Greece defaults, yes, there would be an initial knee-jerk reaction, but slowly and steadily, as the market would grapple with the situation, there would be a bit of a differential trade that would play out. So perhaps US will pretty much do its own thing and the market would be able to be resilient. The impact would be more felt as a risk-off for European markets as well as emerging markets.
I mean, that's true, actually. I mean, I don't expect a Grexit, but I'm saying that if Greece was to go out, let's look at it from a different point of view. At least you will have a template of what happens to a country if they don't follow the right policies. So you will have a short-term reaction to it. But again, as one of the panelists has mentioned, is that the GDP is only 2% of Eurozone GDP. So clearly it is not going to be a big impact for the whole market. And now to your point about will European markets react negatively, I am still of the same opinion that, I don't think the European markets will react too negatively. You might have a bit of a down leg, but then people will come and buy it because, we are talking about US raising interest rates, we are talking about global economy getting better. So it's almost like we are in the second half of the economic recovery cycle, and very soon we'll start talking about the inflation numbers. Inflation is getting better. Well, I hope so, because that's what central banks want. So I take your point that, yes, there will be some amount of movement, let's get back into the US equities. But frankly speaking, European equities are much cheaper and offer you better value than the US equities. So there will be a big amount of money which will again come back in. And of course, everyone is waiting on the sidelines to see what happens. But if you are buying German or French equities, then you are less concerned. If you're trying to buy peripheral equities and peripheral financials, then clearly you are going to be far more cautious.
Right. Dr. Harding, let's get some closing comments from you as well. Same time next week, which is 5th of July, the picture will be clear. We would know which way an average, what does Greece want? Do they want to be part of EU or do they want an exit from EU? So possibly same time next week, what do you think we could be discussing?
Actually, I just want to add to that. Will the picture actually be clear? I mean, same time next week, or would we have to come back again and work the Sunday?
I think it's very likely that all that will be clear is the mood of the Greek public. This is bound to be tied up into some negotiations and some thinking around whether or not the Greek government actually has legitimacy now. And what you're seeing is actually across Europe a crisis of democratic legitimacy, and that's quite clear. The ECB, they're not actually elected. ECB members aren't actually elected. Germany itself doesn't have a mandate, either a constitutional mandate for any type of financing outside its own borders, including QE. And Greece at the moment doesn't have a mandate, an electoral mandate for implementing austerity. So one thing we will be clear on by this time next week, or at least after the Greek people have voted, is the fact that the Greek people will have said yes or no to austerity. And that, I think, is very clear. Will we ever have a solution to the Greek problem? I don't think so, actually. I think this is an issue that's going to need to be discussed and thought through. I think, like other panelists, I'm fairly sceptical about Europe's capacity actually to come to a crisp decision on whether or not Brexit will actually happen. It may have an impact on the European economy, but it's likely to be very small. And in the end, actually, the consequences, the politics of all of that and the geopolitics of that are more important. So will we be back here this time next week talking about the same things? Quite possibly, yes, but at least we'll know what the Greek people have said.
Okay, so we will wait and watch till next Sunday. Thanks very much, all of you, for joining us today and putting things in perspective as far as the Greece crisis is concerned and how that would impact markets for the coming week.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.